All right. Hello, everyone, and thank you all for joining us during the Lytham Partners Fall 2023 Investor Conference. My name is Robert Blum, Managing Partner of Lytham Partners. During this webcast, we welcome Saturn Oil and Gas, ticker symbol of SOIL on the TSX and OILSF on the OTCQX. And joining us today from the company is Saturn CEO John Jeffrey. Today, I've asked management to run through the company's slide presentation, and then we will engage in a question and answer session at the conclusion here. Before I do turn it over, I want to remind everyone that management is available for one-on-one meetings later today. If you've not already signed up for a one-on-one and would like to do so, shoot me an email. That's Blum, BLUM at lythampartners.com, or visit the website, lythampartners.com/virtual. Click on that one-on-one meeting request button, and we'll look to get you taken care of. So with that said, John, let me turn the floor over to you to walk through the presentation.
Robert, thank you very much for having me here today. And just so everyone knows, this presentation in its entirety is posted on the website. So if I scan over anything, feel free to jump on there at saturnoil.com and take a look if anything sparks your interest. So as Robert said, yeah, we're traded on the TSX at SOIL and the OTCQX at oil.sf. So where we're starting off here is page 3 in Saturn's free cash flow strategy. So what we've done over the last really 4 years is we've grown quite considerably. So our strategy since 2021 has really been to look for undervalued assets. I think that right now in the marketplace, there is a lack of capital, and that's really weighing on the price of that you're seeing assets transact at. So we've done kind of 3 major transactions. First was in June of 2021 with the Oxbow deal. Next was in July of 22 with a Viking deal, and most recently with our Ridgeback deal in March of this year. So you can see we've grown from about 200 barrels a day to over 26,000. Right now, you're going to see us exit the year between 27 and 28,000 barrels a day. Right now, we're looking at a 2023 exit EBITDA for about $375 million, or about $2.25 cash flow per share. So right now we're trading at about $2.60, so about 1.2 times cash flow. What's unique about us is we're almost entirely a light oil story with over 15 years of drilling inventory ahead of us right now. Just touching on those acquisitions real quick. This is the deal, again, we just completed February 28th of this year. $525 million. We paid 1.7 times cash flow for 17,000 barrels a day. Again, fitting with our light oil story, this was over 71% light oil, paying just around that $30,000 a flowing barrel. So really fantastic deal for us. Largely oversubscribed in the market when we went, and financed through $375 million of term debt with our first lien lender, which is a family-based office out of New York. Taking a look at the corporate profile, we have a really aggressive debt repayment schedule. So right now we're repaying $25 million a month towards our debt, or about 8% of our market cap when you view it in those terms. Exit debt at the end of the year will be about $450 million net debt, or about 1.2 times EBITDA. And how we do that is about 60% of our cash flow goes towards debt repayment, while the remaining 40% goes towards sustaining production. As we get those debt levels down, you're going to see more of our cash flow going towards growth than debt. But for right now, it's rapid debt repayment until we can get in a position where we can shift more of that capital towards growth. So right now, our design is really a stay flat model until we see that capital or that debt ratio drop below 1. 138 million shares outstanding with an enterprise value of just shy of $900 million today. Light oil and liquids about 83%, and really about 80% of that is light oil. Looking to exit, looking for the last half the year, about 26,500 barrels a day. So because we are such light oil focused, one of the things you'll see is that we are constantly either number 1 or at least in the top 5 when it comes to netbacks. You've seen us reduce our costs by over 20% in the prior 2 years. And furthermore, we'd like to get those costs below $20 a barrel, so almost another 15% reduction from where we're at. You've seen royalties come down quite a bit. As we continue to develop, we're developing more on Crown land or land that we own the mineral rights on. So that's going to see us further reduce our royalty percentage to hopefully below that 10%. Again, all participating in that higher operating netback. So we have three core areas at Saturn. The Cardium being just shy of 9,000 barrels a day, our Viking field just being shy of 5,000 barrels a day, and our Oxbow, which is around 11 to 12,000 barrels a day. So those are the three core areas. And again, with all the different acquisitions we've done, you've seen our EBITDA jump from 18 million to almost 100 million in the Q2 of this year. And you're just going to continue to see that grow as we continue to develop and we continue to improve our margins on a per barrel basis. And right now, with just shy of 1,000 book drilling locations, we have about 14-year reserve life index right now. Taking a look at our Southeast asset package, why Ridgeback was such a great fit for us is that their Viewfield package, which is on the western edge of this map, fits so well with our legacy production. We were able to create a lot of synergies between this. So with this merging of these two companies, we're able to shave $10 million out of the G&A side and over $15 million of the operating side because these assets are so contiguous, and we are able to blend our operations and cut quite a lot of costs out of it. Right now, we're the biggest infrastructure holder in Southeast Saskatchewan with over 4,000 kilometers of pipeline, 72 key facilities, and the only producer-owned gas plant in this region. So it allows us to develop very quickly and inexpensively as the infrastructure is already there and we have idle capacity. And we're able to take that spare utilization that we do have and basically lease it out to other oil companies, where we're able to take what is otherwise a cost center and turn it into a profit center until our drilling comes along, and then we need that capacity back. Taking a look more specifically at the Manor Spearfish. So these are the 5-well results that we have results for right now. What you'll see here is that we're actually 33% above type curve here. And given that strip price of oil, those 5 wells have a projected return on investment of over 200%. Viewfield Bakken is a very exciting play for us. So what you're seeing here, specifically when you get to this northeastern edge of the Bakken play, where the Bakken begins to thin out a little bit, you'll see our offsetting producers are trying these multi-leg laterals. Same thing they're doing in the Clearwater. So what they're doing is they're bringing in new technology into this area. And at first glance, we have almost a year's worth of production. It looks very successful. Everything in yellow to this map on the left is actually land that we own the fee simple land to. So all of the development that's going on up here with this new drilling technique is very exciting. It could open up another 100+ locations for us, which again is all outside of our booked reserves. And this is all additional upside and a very exciting play that we are excited to get into. You'll see us drilling our first one of these next month, November, mid-month. Our Cardium is another big play of ours. The exciting thing here, again, we have a big infrastructure play as well. We have almost 140 book locations, so very de-risked. We are essentially just farming for oil with another potential 100+ locations. As we step out and explore different edges, you'll see us continue to add to our book locations with over 20 years of drilling inventory here. Again, this is great, stable, low decline production that we're very excited about. So it really comes down to, what have we been able to do? Well, in addition to getting our costs down and driving our G&A down, we've also been able to outperform. So when you look at type curve, which measures not only our own projections, but also that of our offsetting peers, those recent Spearfish wells, like I mentioned, are 33% above type curve. Our Oxbow wells, the Mississippian Formation, Southeast Saskatchewan, are 15%. And in the Viking, we're over 52% ahead of our type curve. Overall, as a program, 37% outperform. Again, this is all over and above what we've modeled. So very exciting for us. Also, when you look at last year's drilling program, we drilled 57 wells. Over half of those were on unbooked locations. So again, just proving up more plays, proving up more fairways, and every year, every quarter, we're also adding to our land position. So it's not that we have a stagnant amount of locations and we're just running those out. We continue to drill and explore, add more locations, add more land base, and to essentially grow our reserves. And that brings us to 2023 guidance. So if you assume $80 oil for the last half the year with actuals in the first half, December production looks to be around 27 to 28,000 barrels a day, with hedge adjusted EBITDA of 375 million, adjusted funds flow of 285. This year we'll do about 130 million of capex, which gives us free funds flow of just shy of 150 million. Market cap of about 390 million. Again, that gives us adjusted funds flow per basic share of 225, or free funds flow of $1.15, giving us a free funds flow yield of about 40%. And where that stacks up against our peers, this was actually provided from Canaccord's research. So we have 6 research houses covering us right now, all with buy ratings, with an average return projection of over 100%, based on our EV/DACF and based on our projected total return. I think all parties have agreed that this should be in line for an easy double, and we frankly agree. And that kind of wraps up the truncated version of our presentation. Again, happy to get more in depth on the one-on-one meetings. And if anyone has any more questions, reach out directly to the company or reach out to the website and have a look.
Perfect, John. Thanks for running through that quickly. I've got a sort of a series of questions here I want to run through here. You've made 4 acquisitions in 2 years. What do you see are sort of the key drivers of your successful acquisition strategy here?
Yeah, I think the big one is just access to capital. I notice that right now, there's been a lot of great asset packages come up. When you have different private equity firms exiting the space and there's just a lack of capital to backfill, we've been quite lucky in that we've had strong debt partners, strong equity partners, and that's allowed us to go after some of these bigger packages with very little competition. So you're seeing us transact at, the original Oxbow deal was 1.3 times cash flow. Ridgeback was 1.7. So being able to get very good, clean assets with long run life ahead of them, that's been the number one thing, is that we're just been opportunistic in the fact that there's good assets coming for sale at historically low prices, and we've been able to transact on.
Well, maybe you sort of hit on it, but my next question, obviously everyone likes a deal or a bargain here. How are you able to acquire these so inexpensively?
Yeah, again, I think it just comes down to the market. Historically, you've seen, especially light oil weighted assets like this. If you look back over the last 10 years, they've traded for $80,000 to $100,000 of flowing barrels, especially at oil prices where we see them today. And we're getting them at a third of that. So again, I think it's lack of capital into the space right now. There's a lack of juniors. Normally there would be 3 or 4 or 5 Saturn Oils out there, startups with some capital can go after these assets, but you're just not seeing it right now.
Yeah. Well, and maybe that really sort of dovetails into the next one here, which is, what sort of sets you apart from, the peers making these same acquisitions? Is really that access to capital?
Yeah, I think the big one is, when we really got started at Saturn, oil was $65. So we really forced to squeak out every dollar out of every barrel. So we never had the luxury of $100 oil. So, we've been forced and just bred to be really efficient with our operations. So when we look at different asset packages, we can see where we can shave costs. Our technical team is quite strong, led by Justin Kaufman, and he's been able to outperform on the drilling side. So I think we can see value where some others overlook it. But again, just seeing these assets sell at historically low prices and us being in a position with our capital providers to take advantage of it has really been our secret sauce in growing and being as successful as we've been over the last 3 years.
Gotcha. Maybe just a little bit on sort of the share ownership here. Talk about percent share ownership that's institutional. I think you've picked up a relatively large shareholder sort of in this last year, and then maybe management's ownership as well.
Absolutely. So I think we're about 65-70% institutional ownership now, which has changed quite a bit in the last even 18 months. 2 big shareholders that came on board with this last deal is GMT and Libra. I think together they're about 35 to 36% ownership, which is a huge feather in our cap. They've been very aggressive in the past, and they've been two of the biggest investors in Calgary, and they've backed many successful names of companies you've definitely heard of. So the fact that they've got that faith and trust in us to hopefully be another win is a great compliment. Insider ownership right now, I believe, is around 5 to 6%. And yeah, insiders have participated, well, myself included, we participated in every financing that we've had, and we continue to even buy in the market and support the shares whenever possible.
Right. All right. Maybe just in kind of a couple of minutes here, you've talked a lot about sort of the oil production, not a tremendous amount on sort of natural gas. Maybe what's your viewpoint there?
I think there's a case to be more bullish on natural gas. I think with the LNG coming on, I think that's going to take a lot of supply out of the market. So I think it's natural gas is a little artificially low right now. So I think that'll come back around. And we are really a light oil story. Natural gas is somewhat of a byproduct, and if it rallies, that's great for us. But really for us, it is light oil. And the big advantage we have being that the crown jewel of our assets is southeast Saskatchewan. So we have easy access to egress. So in that Cromer system, we've never seen pipeline apportionment. So even in 2018, when you had, massive apportionment throughout Alberta, we didn't experience that in southeast. So that gives us an advantage. But overall, I'm just extremely bullish on oil. I think with the turmoil in the world and OPEC and Russia being firmly in control of what oil price is doing, I think you're going to see them try and steady oil between $80 and $100, and I think that's a great price for us. That's exactly where we want to see it. I think north of 100. I think you get too much money flooding in. It's difficult to get drill rigs and everything, but between 80 and 100 is exactly the sweet spot we're hoping for.
Perfect. Any final comments or closing thoughts for investors to take away here?
Yeah, one question we get all the time is, how is it you guys are trading so cheap compared to your peers? And I think the answer that we've kind of developed is because we've really come out of nowhere. So again, 3 years ago or 2.5 years ago, we were 200 barrels a day, and now we're almost 27,000, 28,000. So I think that we just have to get better known. So we're happy and lucky to be participating in conferences like this, getting out, doing those non-deal roadshows, introducing people to the story. But even, we were on a roadshow last week, and half the people we had met had never heard of us. And these were oil experts. So just getting out, getting our story told, and continuing to perform quarter after quarter as we rapidly pay down that debt, I think it's going to start getting exciting, and a lot of people are going to be interested in the Saturn story.
Gotcha. Well, perfect. Let's leave it right there. Thank you so much for your time today. Greatly appreciate it. And again, I do want to remind everyone that's listening to this presentation here, if you've not already signed up for a one-on-one meeting and would like to do so, shoot me an email. That's Blum, B-L-U-M, at lythampartners.com. Again, visit the website, lythampartners.com/virtual. Click on that one-on-one meeting request button. We hope you all enjoy the conference. John, again, thank you very much for your time today.
Thank you.